Now friends, very simple. Let's end this entire session with a very simple Excel model, and from there you will actually appreciate a lot of things. So first of all friends, let me just give you a gist of how to call out some data to start working. Okay, I will share this Excel also for you on the offline session, so that offline also you can actually go through it and can revise it. So very simple friends, you go to Google and then you type here historical prices of stock. Let me just go back here, select my mouse. Okay, so you select here historical data NSC. Here you will see this NSC first data point. You click on this. Here you will be asked to select the index, right? So the market here is nothing but Nifty 50. Market here is nothing but Nifty 50. I will take the last 1 year data. So you see here friends, for last 1 year, whatever has been the daily return of this market. Daily return is what? Your market is opening up at certain price, it is closing at certain price. So this is the return of that stock. So every day the return is closing at different points. You can clearly see this. So you can download this Excel file. Okay, you can download this Excel file. So you will get all the data points for last 250 days or last 1 year day wise. Then friends, what I will do is I will type here Infosys. Right, you see Infosys I have typed. Here also I can clearly go in their historical data. See, here is the historical data. I will do the same thing friends. I will type here, I will press 1 year, and here for the last 1 year, right, for the last 1 year I will get this data. You see, for the last 1 year I have got this data. Day by day they have given me what was the stock price, at what price did it open, what price it closed, right? Because opening and closing price will help us give what would be the daily return. Daily return is nothing but at whatever price it closed last day. Today it opened at today it closed at some other price. So the difference between the two, or the ratio between the two, is effectively the return, right? Now friends, let me go to your working sheet. This is the same working sheet friends which I use to not just prepare you for the exam, but also for your financial world or for your jobs, right? So let me just use this. Right, let me open this sheet for you. This is the working sheet, how to CFA. So what I have done friends is very simple, right? Very simple. What I have done is very simple. You see, these are the dates, various dates of Infosys. I have put all those dates. Let me make this slightly bigger so that you are able to see this better. See friends, what I have done is for various dates, I have put the opening price of the stock, the closing price of the stock, right? And what would be the return? The return is nothing but very simple. For any given day, what is the return? Return is nothing but the closing price divided by the last closing price minus 1. Very simple. Look at this point. This point, you can clearly see on 25th of October, it closed at 17,656. On the previous day, it closed at 17,730. So on this day, it actually lost money. So your return was minus 0.4%. Similarly, for all these, you can calculate the values, right? Then what I have done is I have pasted the values of, this was the values of NSC, which is the national, which is the Sensex in India, or the stock exchange in India. Then I have placed the value of Infosys stock. This is a stock under consideration. It is an IT stock. So what price was it opening at various days of the year, and at what price was it closing? So I have put both these prices and I have calculated the daily returns. Daily returns are nothing but at what price did it close on a particular date divided by what price did it close the previous date, right? Because the difference between the two is going to give you the return. So I have calculated friends very simply the returns. I have calculated the returns. Next up, very simple. This is the formula of covariance. What was the formula? I will effectively beta covariance of I and M. I is nothing but this is stock price. These stock returns are there, and these are your market returns which are there. So I will calculate the I will calculate the covariance of these two, and I will divide it by the variance of the market to calculate the to calculate my beta. Very, very simple. So let me use this formula is equal to covariance. I have taught you this formula already, friends, in our quantitative method section, right? Press tab I comma m. So I want to use this data comma, what is my market? Let me go to my market. Let's just see where is my market. Right, this is my market. So I have selected this data. I will close the bracket, divided by variance. VAR you will type. It will show you. Press tab button. Variance of the market. Right. This is the formula of beta. So now you divide both of them, and what answer are you getting? 1. What is the answer you are getting, friends? 1.34. So this is your value of beta, which you have actually, as an analyst, friends, somebody just like you who would now have qualified CFA and would have become an analyst would have been doing this for a lot of these companies in some of the top-notch financial institutes, because calculating the beta would help you predict the future value, right? Like for example, friends, I just gave you an example. Remember, I just gave you an example. Let me rephrase that example over here for you. Remember, so tomorrow, if you have to predict that if the market is going to go to 10%, then where will the Infosys stock be to answer this, right? Because basis this prediction, remember, as an analyst, your role is to predict. So basis this prediction, you are going to take a call how much money you should invest in Infosys, right? You should tell your clients. So how will you do that? You will calculate the beta of Infosys and use this formula that the return of a stock is equal to risk-free rate plus RM minus RF, which is the excess return of the market over the risk-free rate multiplied by beta. So now what is the risk-free rate? 6%, say for example, plus RM minus RF. So this was already given that in future, what is your rate? 10% minus RF. What is RF? 6% multiplied by beta. Beta was what? You have already calculated that beta is 1.34. So when you put these values, you will get that Infosys stock will go up by 11.2%. Now, depending on your client's ratio, you will actually either invest in this. Say, for example, if your client would have said that no, please don't invest in any stock which is less than 15% return, then in that case, you would not have put your money here. Otherwise, if your client's mandate would have been to invest in any stock which is giving you whatever 5-10% return, then you could have easily invested in this stock. Got it? So, friends, now let's go back and see whether this number which you have calculated through your Excel and through your super analysis is also there in the market. So, let me just go there and let me just open up money control. So friends, I have posted this over here, so don't worry at all. I have already posted this money control link and the link of NSC as well in your Excel, so you can very well click over here and you can go here. So let me click on this and let me just show you here on this screen. Command V and C. So this is the Infosys stock. So you can go to moneycontrol.com and you can type in Infosys and it will give you all the details of Infosys. So Infosys today was trading at 1427. Today's return was minus 0.45. So it lost 6 rupees today. This was as of 20th October 2023. So now friends, you clearly can see, you go down, you will see some overview. You will see lot of data points over here. And if you see friends, see here, what is the beta shown over here? See, can you see? You can clearly see that this is the beta. This is exactly the same beta, friends, which you have calculated. So today, I have not just empowered you through a beautiful formula and beautiful understanding, but as I keep telling all of you that we are not preparing for the exam, we are preparing ourselves for the real financial world. As an analyst, how would you calculate beta? So I showed you how through your Google research on your NSC website, you can actually download all the daily returns of stock as well as the market. Then you can do the beta formula on it. Covariance of I comma m divided by variance of m. and you can calculate the beta. Just to be sure whether your beta is correct or not, you can always check it through your website here, right? Now you might be wondering, "Okay, sir, you might be wondering, sir, if we can directly look at the beta value from moneycontrol.com, so why do I need to do this analysis, right?" But that's a very funny question. Why? Because someone just like you would have been calculating this value day in, day out in moneycontrol.com, where he would have been operating as a financial analyst, and he or she would have been doing this. So, depending on which roles you are in, you would be asked to calculate certain beta, and in certain cases the beta might not be available through publicly available information. Infosys here is trading in the market. What if you are evaluating a stock which is not trading in the market? It is still a private listed company. So in that case, you can't just go to a money control or Google and look at beta, because that would not exist. Because on these public forums, only and only which kind of data exists? The data which is public. So hence, in that case, you will need to use this formula, right? So hence, very, very important, friends, that whenever you are learning any concept, make sure that you also are able to apply that in the real financial world. And I will ensure that you do that. You just have to be with me and ensure that you are learning this entire CFA curriculum in the right manner. With that, friends, see you, and I will see you on the other side with our next another interesting session on portfolio management. Thank you for now.